Bessent at the US Treasury. Markets cheer Trump's pick. Welcome to Market Insight. I'm David Pollard. US Treasury yields slipped back on Monday after Wall Street money manager Scott Bessent got the nod to be the next Treasury Secretary, with markets hoping his take on tax cuts and tariffs may at least be sensitive to edgy investor concerns. Well, Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors, is with us. Welcome, Randy. Do you feel less edgy with the thought of Scott Bessent taking the helm?
I think Bessent is a good, essentially moderate pick that is going to calm markets somewhat in terms of who's going to be running the Treasury. And he's got a very clear agenda he wants to try to achieve. He talks about the three threes: getting the deficit down to 3% of GDP, getting oil production up to 3 million barrels, and getting 3% GDP growth. So if he's actually able to achieve that, obviously that would be very good for the economy and very good for the stock market.
And how do you think it'll play into our view on inflation? This week, the shorter term view on price pressures will be a focus when the release of the latest PCE price index is expected to show those price pressures building. To what extent will that be a concern for the consumer and the investor as the US hits the holiday season?
So obviously, as you mentioned, we get PCE on Wednesday. That's the Fed's preferred inflation measure. What that's going to really show, I think, is that inflation has grown slightly on a month-to-month basis. On a year-to-year basis, it's forecasted to be about 2.3% for the base number and about 2.8% for core. I think what we're finding is that last little bit of inflation is very sticky. Importantly, if you look at the US bond market and the 2 to 10 year US Treasury spread, that spread has really flattened out over the last couple of weeks. And I think the reason for that is that investors are thinking that inflation is actually going to be stronger than initially anticipated in the short run. I think that is partially due to the fact that Trump is likely going to be very stimulative to the economy. He's going to be pro-economic growth. And I think because of that, inflation is likely over the next year to maybe not come down quite as quickly as we initially hoped.
Now, this, of course, is a very big week for retail earnings. Target shares were badly mauled last week on its holiday season forecasts. What do you expect to see from the likes of Nordstrom, Abercrombie & Fitch and Kohl's this week?
So in the consumer area, it's really been the companies that can deliver value in terms of pricing and basic necessities that have been doing well. High-end luxury goods have been softer, and companies that can't really deliver what the consumer considers to be a value have not done well. And as you mentioned, Target, I think that's a great dichotomy you can see there. Walmart had same-store sales of 5%. Targets were up a little bit more than 1%. So you're really seeing that play out in the marketplace. We think companies that can deliver that value are going to actually have quite good results, and companies that can't are going to see their same-store sales actually be a lot slower. This is also playing through into the holiday season. If you look at Wall Street estimates right now for holiday sales this year, they look like they're tracking in the low single digits, kind of that 1 to 3% type area. So while we think there will be some growth in Christmas sales, we don't think it's going to be a gangbusters Christmas by any measure.
So what might that mean for earnings? Barclays has today raised its 2025 forecast for the S&P 500 to 6,600 from 6,500 on robust potential earnings growth, in particular in mega-cap tech stocks. Does that fit with what you've seen so far this earnings season?
If you were to strip mega-cap tech out of the S&P, then earnings growth would have only been about 2% for this quarter. Right now, the S&P looks like earnings growth is going to come in around 8% for the quarter. Again, technology is a huge component of that. One thing that makes me a little bit nervous is that if you look at estimates, investors are looking for an acceleration in both sales and earnings over the next year. And importantly, they're really looking for margins to expand, as estimates have earnings growing much quicker than revenues in 2025. So I do think we're going to need some productivity gains. We're also going to need a little bit better economic growth outlook for these numbers to actually be achieved. This past quarter, as results came in, estimates for the fourth quarter of 2024 actually came down. They came down from over 10% to closer to 7 to 8% over the last several months.
What about the fortunes of Wall Street more broadly? Under Trump, the focus may well be on domestic manufacturing and supply chains. Will that be enough of a catalyst for a significant rotation from, for example, large to small caps?
Well, one issue with small caps is, though investors have been looking for this rotation from large to small because of valuation, but also because small caps are more focused on the US economy, we actually need to see that start to come through in the numbers. If you look at the Russell 2000 revenue growth, this last quarter, it was about 0 versus about 5.5% for the S&P. So we really need to see an economic pickup, and that actually translate into better sales for small cap. One other comment I'll make with regards to Wall Street. Wall Street is very optimistic that under the Trump administration, we're going to see a big increase in both mergers and acquisitions, but also IPOs and secondaries of US stocks. So that's been reflected in the investment banking stocks doing very well since the election. And I think all of Wall Street is hopeful that this is going to restart the deal calendar.
Okay, Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. Many thanks for being with us today and sharing your thoughts. That is Market Insight. We have more videos on Reuters.com.